So today I'm going to talk about a stock that I have just sold. So I sold this stock, and what I like to do on this channel is when I sell stock, I like to talk about why I sold it and the reasons behind it. And even if I sell it for a profit, I can talk about why that investment worked out and how I was able to make money. And hopefully for you guys as an investor, that helps you improve as an investor. And same as if I'm selling this stock out and I sell that stock out for a loss, hopefully making this video, I can see where I went wrong as an investor and also share that with you guys. And once again, that hopefully helps you be a better investor. So getting onto the stock that I sold recently, I sold this stock for a 50% gain, which is obviously really good. And I'll go through the reasons why I'm currently selling this stock and also what I plan to do with the cash that's now available from selling this stock. So I hope you enjoy the video. Let's get started. And just a shout out, if you do want to know what I'm buying and selling in real time, the place to be is on Patreon. Join through the link in the description. It's only £5 a month. You also get 2 exclusive videos a week on there. And if you do want some free shares, join Trading 2. That's the broker that I use. Join through the link in the description. You can get a free share worth up to £100. But getting on to the stock that I have sold. So I sold my shares in Moonpig. I sold my shares in Moonpig for around about a 50% gain, which is obviously pretty decent. And I started buying Moonpig only in the last year. And for the first time for a long time, I actually caught the bottom of the stock. Normally it's the other way around, but this time I actually caught the bottom of the stock. So it was a stock that IPO'd. It IPO'd around 2021, around about £4.39 as you can see here. The stock then from 2021 kind of got peaked in that kind of high valuations, IPO valuations, and as well as that, it had an online boom. Obviously, what we know is online retailers went crazy in 2021, and then through 2022, they all had a reality check through valuations, and also the growth struggled a little bit as a lot of demand were pulled forward, and the stock went all the way down to about £1.10p. And I was looking at that thinking, okay, this is a pretty good valuation for Moonpig. I'm going to buy some shares here. Obviously, that's in December 2022. You know, you guys that have been in the market for a year at least, you guys know the amount of fear that was around in 2022. I thought this is a good opportunity to buy some shares in Moonpig. Now, like I said, I caught the exact bottom, and from there it rallied up, and I was able to take a good 50% profit out of this company last week, as you guys on the Patreon know. So today I wanted to kind of go through the reasons why I'm selling this company. So the first one is the position size. So as I said, I caught the exact bottom of this stock, and I was willing to pay around about £1 for this stock. Now obviously it's gone up to about £1.66, so the value has increased by 50%. Unfortunately for me, I don't want to buy at this level. I think the valuation is okay, but it's not where I want it to be. I want it to be at a good valuation. For me, the good valuation is towards £1. And because of that, I can't buy any more shares at these sort of levels. So it's a relatively small position, so I thought I'm going to take the money here, and if at the end of the day, if it does go back to £1, I can buy back in. If it does go up, fair enough, I did get it wrong, but I think the upside is a little bit more limited at this sort of valuation. So the first reason is that just because I wasn't able to build up a big position size, it's not worth it for me to keep doing the research of keeping up that position. You imagine I've got to be monitoring that position probably every couple of weeks. I've got to listen to earnings calls. I just thought, you know what, let's just take a nice short-term profit here and we can use that into another investment. So the first thing was the position size. The next thing is the valuation. Combined with the position size, I was looking at this going, I'm not a buyer. Upside, I don't know how much upside's left. It currently trades at 20 times earnings, which is about the market average. So if it's going to go higher, it needs to go to a premium. I'm looking at the company here and I'm thinking, well, the company currently does around 26 million in profit. It goes up to 32 million in profit. Sure, you're a little bit cheaper then, and if they carry on going profit, then if they do these numbers, then it could look a little bit undervalued and it could go up a bit more. But then I also weigh that up with the risk, and the risk was, can they actually hit these numbers? So you can see here they are expected to go back to good amounts of growth after the drop down in revenue and the stagnation in profitability. And I was thinking, can they go back to these numbers that analysts are forecasting? And I weighed up that with the risk element. The risk element for me is that Moonpig are actually going to be bringing out earnings very soon. So they could have a pop-up in September, and I look a bit of an idiot. But I've got to go with the information that is relative to me or I can trust at the time. So you can see here that there is going to be a trading update on the 19th of September. So all the information here will get thrown out on the 19th of September as we get a bit more of an update of what's going on inside the company. Now, the thing is that when I look at the last update that Moonpig gave us, which was quite a while ago actually, if I scroll up, this actually came out on the 29th of June. So it was a little bit ago when we got this last bits of information, but you can see here that they said that they expect to grow revenue at low single digit percentage rate in the first half of financial year 24. Okay, so that is below what currently analysts are forecasting for them to kind of grow at here. So they're going to need to see a big rebound in the back end of the year. And if you look here, for the full financial year, we expect consolidated revenue at a mid to high single digit percentage rate, which is a big rebound from where they are at right now, which got me worried. Like, can we see them do that? Is the rebound going to be there? Now, it does say that adjusted EBITDA margin is expected to remain resilient. Now, there's no confirmation on the EBITDA margin there, but I also thought that was a little bit worried that there was no confirmation on the margin. But looking at the revenue growth, they have to see a big rebound in the revenue growth in the back half of the year. Now, what do we know about that situation? Well, we know the current environment is a little bit weaker. I think people were hoping for maybe a bit more of a bounce in the back end of the year than what's currently going on. And the thing is me as an investor, I've been in multiple companies where they go, yeah, we're going to rebound by the back end of the year, and they don't. And then what happens if they don't and they have to downgrade this guidance that analysts are forecasting is the share price gets hit, and then do we see Moonpig go back down to the £1 range? Now, obviously, if they do come in with this guidance that they're expecting here, I would expect Moonpig to rally up a little bit. I can see that happening. But my concern is, what if they don't? I want to think worst case scenario. And I've seen this before where companies say they're going to rebound at the back end of the year and they don't rebound at the back end of the year, and it kills the stock. I can give you two examples straight away. So another UK stock that I said own there like I don't own anymore. So one UK stock I own is Boohoo. Now, Boohoo have said for the last maybe year and a half they're going to see the sales rebound. Still to this day, we have not seen Boohoo's sales rebound. And that has meant the share price has been stagnated very, very low because there's no growth coming back into the business. Another one is Corsair. We were supposed to see the rebound in Corsair's earnings in about 2022. Never happened. That means the share price has been stagnated really low. And same with what I'm looking at Moonpig here is they're saying revenue hasn't recovered yet, but it will recover by the back end of the year. Now, for me, I would like to see that start showing signs, and that's the thing. I think if Moonpig come out and say that the growth hasn't been good as expected and that online boom hasn't come back, people are still going to Card Factory, which is another stock that I own. People are still staying on the high street. They're going for the cheaper option. I could see the shares fall a little bit. So I don't know. I don't know what's going on inside the company. I don't know if they are hitting these targets. If they do, the shares might go up a little bit more. If they're below these targets and they haven't recovered, the share price go down. So I'm just managing that risk there as well because I don't know what's going on inside that business. So we've got the kind of the position size, the valuation, and also the risk of can they hit the financial numbers. They've got to see a good recovery in the back end of this year. The last point that came into factor was the balance sheet. So if you look at the balance sheet, they made a lot of acquisitions, big acquisitions, and this is probably a factor of the share price going down, that a lot of investors looked at the investments or the companies they were buying out and going, they're big investments. You know, they've really got to make those investment work to justify the debt that they take onto the balance sheet. And you can see here the debt that they did start to take on the balance sheet was a lot of debt. So at the moment we sit on around about 170 million in debt. Now, not too bad considering the company is around about 560 million-ish. So it's not too bad to the market cap size. But the problem is that you sit on 22 million of cash. So the debt is quite relatively high to the cash. They cannot pay that debt off overnight. And also considering that the company is forecast, let's say they hit the targets and in 2024 they do 32 million in cash. If they even focus all of that cash to the balance sheet, that's going to take them many years, or probably around about 6 years, to actually pay off that balance sheet. If they focus everything, all the cash, into buying down that debt. So that's going to take a while for the debt to get paid down. Now, the other issue that I have is that what environment are we going into at the moment? We're going into a higher interest rate environment. So if we're going into a higher interest rate environment, if you've got a lot of debt, 170 million in debt, and you're going to have to start refinancing that debt, and that debt came on in 2021, let's say you're financing that debt. I actually used to know these figures and I forgot them, which I apologize for. But let's say you're financing that debt at 2 or 3%, that isn't too bad. If you have to refinance the debt, which I think comes up next year, I believe, for Moonpig, you'll have to just double check that. But I think the debt comes up next year and the refinance starts kicking next year. If you're starting to refinance that debt at 7, 8, 9%, that's a big difference. And what we've seen in this environment is higher debt companies like the likes of National Express or Mobigo Group. We've seen before how much that can hurt the share price and can hurt the earnings with having to pay down that debt in a higher interest environment if you have to refinance at higher interest rates. So that's something that I'm also being a little bit cautious of, is that they are very debt heavy, and also they're moving into a higher interest rate environment. And can that affect the profitability if it comes to refinancing at higher interest rates? And also you take that into factor, if you're not growing profitability, that can be a bit of an issue. So as you can see, there was a few factors that came together for me to sell out that stock, with the valuation, how much the shares have run up, the position size, the risk element, the growth having to return, and the debt all came together to kind of think, you know what, let's take the profit here, and if it goes up a little bit, fair enough, but I think the upside is a little bit more limited. And also if it goes back down to £1, I've got a chance to maybe buy back in at a cheaper value, and I've already took my profit here. So that was the big factors. The big thing that pushed me across to go over the line was there was actually another opportunity that came on the market last week. So as you guys would have seen recently, my big thing at the moment is to build up a cash pile. I want to build up a bigger cash pile at the moment. Now that meant that I don't want to be putting new cash in to buy an opportunity. So with me buying a new stock, that obviously adds a position size, adds more work. So I want to take that element of, okay, if I'm doing more work, I need to level that out by cutting down the research that I'm having to do on one stock. So there was the balancing out of the amount of position size I have, and I looked at this opportunity, and I looked at the opportunity thinking, I think that's a better opportunity. I think my cash is better in this stock than having it in Moonpig. So the combination of a new stock available at good rates, I thought that was probably better to move that cash into that opportunity. Now, some of you guys might be asking, what stock is that? And unfortunately, I'm going to save that for another video. I'm going to do that probably a bit later on in the week. So unless you're on the Patreon, you guys know what stock that is, so keep it a little bit secret. But the stock that I did buy with the cash from Moonpig, I'll tell you guys in a little bit. I'm going to hold that one back for another video. So I hope you enjoyed it. Hit the like button if you're new around here, subscribe. I'll see you in a bit.